Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about inflation, which is obviously top of mind for so many of you. And the January numbers came out for CPI here in Canada. For the first time since the early 90s, we're over 5%, 5.1% inflation year over year from January 2021. So we're going to break down the StatsCan CPI numbers, where that inflation is coming from. And then we're also going to look at historic inflation. What are the CPI numbers long-term in Canada? Because that's a big part of your retirement. And what should we look at in the past to kind of reflect what maybe will happen in the future. So let's break down the CPI index. Again, this was just released a couple days ago. If we exclude gasoline, and I don't know if you've been to the pump lately, but having 4 kids, my wife drives a minivan. So of course we have to fill it up with gas. And the last time I filled up, it was $1.79 here. It seems to be getting exponentially more expensive as well. And it's funny because Matthew that works in the office here, he said the other day, he's like, I just saw gas at $1.65 and I pulled in quickly to fill up because I thought it was a good deal. We kind of just get used to paying more and more. So if we see a little bit less, it's like, man, that's a good deal. But we were paying way less than that even, a year or 2 years ago. So if we take gasoline out, CPI rose by 4.3%, which is obviously still a massive number. Include gasoline, we're at 5.1%. So let's first look at shelter costs. Shelter costs, living costs, 6.2%. Massive jump year over year. Again, a lot of people say, look, to get into the housing market, it's super expensive. I can't afford it anymore. Pricing has gone crazy, especially in major markets across Canada and in the US for that matter. If we look at people that own homes, we can see here that the cost of home ownership has jumped exponentially as well. So again, we're up at that 6.1% range. Homeowners replacement costs 13.5% and 14% on accommodation expenses. So again, large increases. Groceries, you're paying way more for groceries, 6.5% versus last year was 5.7%. Frozen beef up 13%. Frozen fresh chicken 9%. Fish, margarine 16.5%. Not sure how that even happens. And I just saw today in the news about avocados. And so the US has stopped importing avocados temporarily. Basically, avocados that are shipped out of the States to Canada, they're expecting a 25 to 50% increase in prices here over the short term. So there's certain pieces within the food aspect especially, we're seeing very large increases in a short period of time. Looking at alcoholic beverages, and this is an interesting one because you can see it's a lot lower than the average. We've increased 2.9%, which is a big number still, but the 2.9% rise is obviously smaller than overall inflation. My older brother is in wine sales, and when the pandemic hit in 2020, their sales exploded, and they've been doing quite well, for the last couple of years. And it's interesting because usually when there's big demand for something, you see prices, go up exponentially as well. So interesting to see that alcoholic beverages actually haven't increased as much as everything else in this world at this point. So I kind of found that one a little bit interesting. So the last thing I just want to highlight within this report is every province is a bit different. So if we look at the provinces here, January to January, you can see the different inflation numbers here. But again, Nova Scotia, 7.1%. Absolutely crazy. Again, inflation's very high. So what does that mean for your portfolio? I think that's really what it comes down to. Not just portfolio, but your overall retirement plan. Do you need to have a 4 or 5% inflation rate built into your retirement plan? That's been top of mind conversation with our clients lately. And so what we did is we created a cheat sheet essentially. We'd always say to clients when we build out a financial plan, we're going to use 2% inflation and a 5% rate of return, which we feel is conservative. So look at your rate of return as inflation plus 3%. But always rather build a conservative retirement plan. And you come back to me in 5 years and say, hey, Adam, we have more than we expected because we've gotten 6 or 8% rate of return, not to 5. That's a way better position to be in than to plan for 8 or 10% return and come to me in 5 years and say, we're falling short. We have to completely change our retirement. We can't do things we want to do and kind of had set to do. Okay, so what we're looking at here is inflation. So Canadian inflation, we're going back to 1986. So in 1986, and you can see this is what I want to highlight. From 1986 to 1991, we had fairly high inflation. 1992 hit and it dropped down 1.49, and it's kind of petered up and down over time. It floats around that 2% for a long time. So what we wanted to do is basically create a scenario of, okay, what is the average inflation over that time period? And if we take that time period, the average inflation is right here. So from 1986 to 2021, the average inflation rate is 2.29%. So that includes those years in the late 80s to early 90s where inflation was much higher for 5 years running. But we also know that things are changing, times are changing, technology, all of that. We want to look at the last 20 years. We feel like that's maybe a bit more realistic, 1.7%. So that's the average inflation rate in Canada for the last 20 years. Why we pick 2% when we put plans together is because we kind of pick a medium point to here. Again, the last 20 years is a bit lower than that. So we bump it up a little bit to kind of create that 2%. And we feel like that's a very comfortable and conservative approach to building out a retirement plan. So if you're looking to build out a retirement plan, don't jump to use 5% because that's what we're sitting at right now. Look at your average over time. And again, at some point you have to take the data and kind of pick a medium point somewhere and use that data going forward. We have no idea. No one has the crystal ball of what inflation is going to do, the markets are going to do, all of that. We have no idea. We don't know what your health is going to do either. That's a huge factor to your retirement plan. You have to plan with the data and the information that you have. The other part that we wanted to look at when we were building this out is, how has interest rates, inflation rates, and overall rate of return kind of impacted each other? So looking at rate of return. So what we did here is we took the S&P 500 from 1986 all the way to 2021. The average annual return is 12.66%. When we took the Barclay Bond Index, which is a mixed bond index of government, corporate, mixed types of bonds, net average return from 86 to 2021 was 6.27%. Now, if I look at the bonds overall, you'll see, there's a loss last year, made money a couple years, loss, you had some big returns back in the day, 10, 11, 9, 18, 9. Again, the last 20 years, it still averaged 4.33%. So it's dropped quite a bit. And I think bonds will continue to drop over time. So what we've done here is we created a scenario where we said, look, if you had a portfolio of 50% equities and 50% bonds, this is the percentage breakdown of your portfolio. If you have a 50-50 portfolio, real rate of return, so after inflation from 1986 to 2021 would have been 7.18%, and your 20-year rate of return, and this is where we kind of use the 5%. That's right, we use 5%. We feel it's very conservative, and it's probably a good approach, 5 to 6% to build a plan out going forward, as long as you're somewhat invested. If we change this to an 80-20 portfolio, you'll see that change, right? So now at 7.58%. Why I want to do this video is kind of bring light to inflation. Yes, we're at a very high level of inflation right now, but it's not the norm. We've seen it before, we've come out of it, and we've averaged much lower. And I think if you're building out a plan or wondering about inflation long term, I would be comfortable going at 2, maybe 2.5% if you want to be really conservative. So if you have a defined benefit plan only and not a lot of investments, the rate of return is non-consequential to your plan. But if you have investments, the rate of return you're getting on your investment obviously largely impacts your plan. You can always update your plan. If you have more money, that's a great solution. You don't want to be updating your plan because you expected 8 to 10% rate of return and you got 4, 5, or 6. So the next time you have a chat with your neighbor or your colleague about inflation, it's not going to last forever. And again, look at that 20-year average as a good guide on what it might be going forward. And hopefully that will help you build out your financial plan. Appetite for risk in retirement should come back a little bit. Again, that doesn't mean you have to own less stocks. It's maybe just the type of stocks you own. So make sure you have a good portfolio manager for that. If you have any questions, feel free to reach out to our office. Check us out online, www.parallelwealth.com/planning. You can learn about all the services that we have to offer. If any of those help you out, reach out to us and we're happy to help you. We'll see you in the next video.